Good afternoon, everybody. Patrick and Angus here for our Thursday macro webinar. Angus, how are you today?
Good, thanks, Patrick.
Okay, so it's Angus and Patrick today. We're going to talk a bit about the markets and what we're seeing at the moment. So here we are, which most of you would know by now. And just the general housekeeping items, we have to go through the disclaimer. All information is provided on a general advice basis. Before acting on any of the information in the presentation, please be sure to check with a financial advisor or consultant before making any decisions. And please remember, past performance is no indication of future gains. During the presentation, we will take comments and questions. You can type them into the presentation. The orange arrow here will direct you to where you can type the question in, and through the presentation we'll endeavor to get through as much as we possibly can with the time that we've allocated. If you cannot hear the presenters or you can't hear the presentation, please give us a call, 1-300-88-1177, and someone in the office will look to help you with that. So without further ado, we'll get on to the presentation, the market update. And there's been a lot going on in the market, Angus, and I thought I'd start with the US 10-year chart here, and I know you got some comments on that for the members today.
Yeah, I mean, the markets, they've been pretty resilient. We've seen the US benchmarks continue to climb. We've seen, Japan has been pretty bullish as well. It's been rising, and we've seen, the ASX 200, the FTSE. So, the markets have been in a bit of a sweet spot. And, obviously, there's a lot of expectation built around these mid-year rate cuts. And, just listening to Jerome Powell speaking again yesterday in the US, he was sort of talking about not being in a rush, not being in a hurry to cut rates. I still think there's some residual risk, around that mid-year rate cut narrative. And, one key financial instrument that I keep a close eye on is the US 10-year bond yield. We can see that it breached a key sort of technical level this week at 4.35%. So, I have to say the technical setup for the US 10-year Treasury bond is bearish, and that if interest rates go up, the bond's value goes down. And, we can see by this chart that if we get any sort of follow through on the upside, we could see, the US 10-year yield sort of head back towards 4.5%, maybe even 5% later this year. What would cause that? Well, I think, I don't want to jump ahead of our webinar, but, could it be that we get another phase in the commodity supercycle, which then leads to higher commodity prices and higher food prices that then feeds back into inflation? And I think there's some risk around that. We're seeing the CPI really struggling to go much below 3. We know that, energy, which is a big chunk of the CPI, US consumers are now paying over $4 a gallon at the pump, and oil prices have also broken out. And I wrote a bit about that last week and again this week. So yeah, all in all, I think it's I still think the central banks are going to cut rates later this year. I'm just not convinced that it's going to be a mid-year story. And I'm just flagging that this 10-year, this rising 10-year bond yield, will pose a risk to the market at some point. Stocks can remain agnostic, but not forever, to the fact that interest rates, are rising. And this big rally in the bond market this year has been notably missing. So it's just something for us to keep a close eye on.
Okay, so just to summarize, so with Wall Street's been has held up recently well, and you're keeping an eye on this US 10-year rate as one of the risks to the overall market at the moment. Is that fair to say?
I think that's one risk. The other risk is, heading into the earnings seasons, over the last sort of 3 or 4 quarters, the bar of expectation was pretty low. Not so this time. You know, a lot of the analysts have really ratcheted up, revised up their profit forecasts. So, you know, there's a lot of that that's baked into the stock market, you know, which is why the S&P 500 is now trading on a 22 times multiple, which is historically expensive by sort of any standard. So, you know, given the bar of expectation is a lot higher now, you know, it's a bigger hurdle for the market to get over. So I think that's something else to be aware of. Now, you know, within the confines of the US stock market in terms of the sectors, I think some sectors are more at risk than others. Obviously, the sectors that led the market last year, such as IT, AI, mega cap tech, you know, all those sort of areas of the market. I think there's risk there on the earnings front, you know, given the expectations are really high. On the other hand, the materials, the energy sectors, there's not so much expectation baked in, and if anything, we could see some quite decent upgrades coming through, given the upward movement in spot prices. You know, everything from sort of copper through to oil. So yeah, I think certainly, you know, some areas of the market probably make a bit more sense at this point than others. And you know, I'm sort of still a bit wary of, you know, what's going on in the AI space, given the high level of expectation that's been baked into those company valuations.
Okay, I popped up the next slide in the DXY chart here. I know you got a couple comments on this at the moment.
Well, I think, you know, what's been interesting is, you know, the US 10-year Treasury has gone up quite a bit. You know, we look back over the last couple of months. I mean, the yield got down to sort of 3.6, 3.7, I think it was at one point. And you know, we saw some weakness in the dollar. And if we look at this chart of the dollar index, you know, we can see that big spike up to 114. That actually coincided with the US 10-year bond yield hitting 5%. So we're at 5.35, sorry, we're at 4.35% today. I guess, you know, I have been surprised that the US dollar hasn't had some more, hasn't had, you know, more of a bid, more of a upward move actually. And, you know, it's kind of looking a bit sluggish. The technical setup for the dollar index is by no means bearish. In fact, it's actually quite a bullish technical pattern. But I guess the surprise really has been that we haven't seen the dollar index follow the 10-year bond yield higher. And you know, I put that down to you know, a number of potential thematics that are sort of playing out this year. You know, I've written about the de-dollarization, Pat, where, you know, we've got a lot of countries sort of looking at what happened to Russia, having, you know, 400 odd billion in assets confiscated and frozen, you know, under the US sanctions. And with that, you know, the interest payments now being, a lot of people are actually asking, you know, for the interest payments to be directed to the Ukraine. And, you know, I'm not saying that, you know, I haven't got a political view here. I'm just saying that a lot of nations would look at that and go, well, you know, we're not really that happy about, you know, keeping our cash and all our liquid assets in dollars and, you know, within reach of the US government. So I think that's real. And I think, you know, these central banks that and these nations, you know, they can't really diversify with Bitcoin. You know, gold is really the only true sort of hard financial asset that they can diversify legitimately with. And I think, you know, this is what's been one driver of the gold price this week. You know, the fact that they've been accumulating, central banks have been buying. And it's dwarfed, you know, the outflows from the exchange traded funds with retail investors exiting and, you know, perhaps switching into crypto. That's been outweighed by central bank buying. So, you know, maybe people are just, you know, some countries out there really sort of scratching their heads over how many US dollars, in fact, they want to hold, trade in, how many US Treasury bonds that they want to keep money parked in. So, I think this de-dollarization is quite real. And, then let's not forget the actual fiscal position of the US itself. They're spending beyond their means. We've seen the national debt climb to 34 trillion. It's going up by $1 trillion every quarter now, which is a staggering number. And of course, the interest payments on that debt are also rising. And this is impacting debt to GDP capita. At some point, the piper has to be paid, and it's going to matter. So I think this is all going to weigh on the US dollar this year. And my view, Pat, that the US dollar will enter a secular bear market. We've yet to see technical confirmation of that, but that's my view, that will happen at sometime sort of later this year. And perhaps the record highs that we're seeing with gold and some of the other precious metals that have been running, and some of the commodities, maybe it's got something to do with that.
Okay, I just wanted to ask you, you and I spoke earlier about, the US dollar underperformance, de-dollarization, and the potential rally in the yen. Do you think any other currencies other than the yen will benefit if that happens?
Look, I think what's going on with the yen is interesting because, we know that the finance minister and the Bank of Japan are uncomfortable with the yen depreciating any further. And, we know that the market is really heavily short Japanese yen long dollars. And, the short position is huge against the Japanese yen. So I don't think jawboning is going to work this time. They can threaten to intervene. It might spike, and that might last for a few days. I don't think that's going to cause a major reversal in the end. But perhaps, with the depreciation that's going on there, the Bank of Japan and the government the Bank of Japan might be forced to move a bit quicker on interest rates. And in which case, they might let that yield gap differential with the US close a lot quicker. I'm not talking about, the Bank of Japan putting rates up to 2 or 3% or anything like that. They might put the cash rate up to 0.5% or 0.75%. They might allow the 10-year Japanese Treasury yield rise to 1.5. Those would be my picks, and for this year, and that could actually begin to turn around the Japanese yen. All of a sudden you've got Japanese investors, repatriating capital, away from the US back to Japan. The stock market's now a good place to be. It's been one of the best performing markets for the last few years running. Japanese companies are doing really well. They are, ramping up returns to shareholders. So, we could see the yen actually undergo quite a big major sort of reversal. That's what I'm looking for. And in fact, Mr. Yen, the quite a well-known finance minister in Japan in the 90s, very accurate for calling the direction of the yen. He's actually calling it down to 125 this year.
Okay. And I know we touched a little bit on the okay. Sorry. We touched a little bit on the commodity super cycle. I thought this was quite an interesting slide, and I know you got some comments on this for the members.
Yeah, well, I think congruent with a weakening dollar outlook, and perhaps sort of sticky inflation is this commodities as a hedge against inflation. I think potentially we could enter a super cycle over the next 5 to 10 years. I mean, simply put, the world's going to need a lot of commodities going forward. I mean, if we take renewables and AI, there's a lot of base metals that are required to build that infrastructure out, that go into making the chips, go into making solar panels. So I think I think that's going to be one driver. Another driver is climate change, which I think will cause a fair bit of disruption in the commodity space. We've already seen it in coffee with some severe frosting damaging the crops in Brazil. We've seen climate change impact cocoa prices in Africa. Cocoa is soared above sort of 10,000. There's real shortages. So, I think this is real, and I think we're going to see commodities across the spectrum move higher. Can we have the next slide, Pat?
Okay. Bloomberg Commodity Index, quite interesting. We've seen a lot of move in the commodity prices recently. What stands out to you at the moment with all of that and the Bloomberg Commodity Index?
Well, I'll just talk about the technicals, and then we can pull up a table of what actually constitutes the Bloomberg Commodity Index. But look, the technical setup here is quite bullish. We hit that big blow off top, which caused a lot of the inflation, by the way, between 2022 and 2020. And then, we had a big retracement. It's almost a proportionate Fibonacci retracement of almost sort of 50%. It's found support. The index has found support, and in the last week or so, it's broken out on the top side. So I think commodities, as evidenced by the Bloomberg Commodity Index, are about to inflect higher, and I think there's significant sort of technical scope for recovery. Possibly up towards the next resistance of 110, and then beyond. Maybe even 120 potentially this year. What was a tailwind for falling inflation could now become a headwind if we see those commodity prices really start ripping on the top side, because the cost of living for people goes up, people want more wages, you have a wage price spiral. If we look at this table, we can see that energy constitutes 30% of the Bloomberg Commodity Index, grains 22.6, the industrial metals 15.5, precious metals 20, soft commodities such as coffee, sugar, and cotton 7%. So a lot of these baskets, things are actually looking pretty bullish. Like we'll talk about copper in a minute. That makes up a decent chunk of the industrial metals basket. Copper's already broken out. I think we're going to see upside reversals in some of the other ones, such as zinc and nickel this year. And the grains have actually been quite well behaved. We haven't seen any major sort of breakouts there, but we are seeing big bottoming patterns for many of them, including wheat. So that's a complex to watch. Energy, we've seen oil and Brent, WTI, they've all worked their way back up to the mid-high 80s, and I think if we see the oil price complex sort of move much beyond $90, that could prove to be inflationary. And of course, the precious metals, with silver and gold accounting for 20%, gold's at record highs, and we saw silver break out this week to more than $27 an ounce. So these are all going to be drivers, I think, of the Bloomberg Commodity Index.
Okay, so if we look at copper, what are your thoughts on copper, and what do you think is driving the copper price at the moment, or going to drive the copper price higher?
Well, I think copper's got a really interesting setup. Seen a topside breakout of a converging or a contracting triangle range. It's a pretty bullish pattern, and it really defines really I call it a continuation pattern. So we had the big correction, from 480 a pound down to 320, and we've had this topside breakout, and we've had extension above the breakout in the last couple of weeks. So I think this is a really good setup, and I think copper's got really good fundamentals. The world's going to need a lot of copper. There's not really a lot of supply coming. In fact, there's going to be quite a big deficit happening, later this year and into next year. Electric vehicles, AI chips, infrastructure, they all require a lot of copper. So I'm quite bullish about this, and I think that copper can head back towards sort of 480, which marked the previous peak about 4 years ago. The great way to play it is the Global X Copper Miners ETF, and this is a chart of the US one. COPEX is the code; it's a US code. This can also be bought in Australia. It's exactly the same ETF. It's a subsidiary listing, same basket of stocks, which comprise, large cap global copper producers. That can be bought on the ASX, and it trades under the code of WIRE. I think this breakout, which has coincided with the breakout in the copper prices, is really the beginning of a re-rating of the copper mining sector.
Okay, so we'll move on to silver. I know it's something you and I have been talking quite a bit about, and it's quite an interesting chart here on silver. What are you seeing here at the moment, Angus, with silver and where this is potentially heading?
Well, I think, we've waited a long time for this. With silver, it's taken a long time. We've had 4 years of ranging consolidation within quite a large range. And since mid 2022, we saw silver bottom at $18 an ounce, and it's risen. We've got a series of higher reaction lows. We have had pressure from the primary downtrend, really keep a lid on the price up until this week, and we've seen copper run from just under $25 an ounce, and it actually was in the 24s. It staged this big upward dynamic to $27 this morning. So if copper can sustain this breakout, I think this technical setup now favors a continuation pattern, and it raises decent amount of scope for further upside. And I think the silver producers still look pretty attractive. They're not really, they're only just really beginning to follow the silver price now. And we can see from this chart that the Global X Silver Miners ETF, which is the one that I favour, which is US listed, that broke out quite dynamic fashion this week. And this topside breakout favours further upside extension, possibly towards the next major resistance level, which is sort of north of $38. Obviously, that ETF, Pat, is a basket of the world's larger copper producers. So it's got Kerr Mining, that's one of our favourites. It's got Fresnillo, which is a UK listed silver producer. There's a number of them in there, and I like the ETFs because you can get equity leverage to the metal without stock specific risk. It's a good way to play it.
Okay, we'll move on to gold. Gold's well, this chart tells it all at the moment. Gold's hit some all-time highs. What are you seeing here, Angus?
Well, just upside extension beyond the breakout, and it's doing it. Gold's doing its thing. It's nice and consistent. At some point we are going to get a reaction and a retest. Markets when they break out tend to, retest the floor. And we can't rule that out with gold, but for now it's running. The base that it built between 2020 and 24 is really impressive, and so we're going to see we could see further upside extension, and I think if we did see a sell-off, I'd see that more as a correction and not not part of something more bearish. And this is going to I think, if I'm right, dovetail in with US dollar weakness later this year. And, all those things we talked about, de-dollarization, central bank buying, investors looking for a hard asset to hedge, rising inflation, this whole sort of, Supercycle and almost a repeat. History doesn't always repeat, but it often rhymes. And I think what we're seeing at the moment really does rhyme a lot with some of the things that happened in the 1970s.
With gold running at all-time highs, do you think the some of the gold stocks have some catch up here to do to track the
Yeah, well,
gold price higher?
I think look, we've seen some good moves this week in a lot of those gold stocks, but if you look at where a lot of them are, and we put that chart up before of where the silver miners ETF was in relation to actually going forward. Go back a bit. Yeah, I think there's further upside to go. I think this is I think we're going to see a significant re-rating of those gold stocks this year. And that doesn't mean to say we're going to get green on the screen every day. There'll be volatility along the way. There'll be some sell-offs, but I think they all look screen cheap, particularly with the Australia. Like in Australia, we've seen the Aussie gold price break 3,500. We've seen the US dollar gold price break through 2,300 for the first time. So this is all going to mean better margins for the gold miners, and the precious metal miners generally.
Okay, we'll move on to the CSI 300. This looks like an interesting pattern at the moment. What are your thoughts here, Angus?
So we're changing track. We're moving from the commodities now to talking about China. I've been sort of getting more and more bullish about China. As it's hard not to when the valuations are now so cheap. The China Hong Kong stock market is now on a pretty low forward PE. It's trading at about 8 or 9 times, which is low, really low by historical standards. Contrast that with the S&P 500, which sells for 22 times, which is priced for perfection. No one wants to own China. Foreign investors have left. Even the Chinese public don't want to own Chinese stocks. So that's exactly the time you've got to look at these markets. And I was a bit of a fan of Ray Dalio. He ran the world's biggest hedge fund for a long time. He's a multi-billionaire, and he's had some great calls on the markets over his career. And he said you just got to look at it when there's blood on the streets. And because people don't want to know about China, that's exactly, and Hong Kong listed companies, that's exactly when we should be looking at them. So if we look at this chart of the CSI 300, let's put the CSI 300 chart back up, please. Look, we're still in a primary downtrend, but we can see that downward momentum is dissipating. We've seen a decent bounce off that big, and the chart that I've got up in front of you is not doesn't take into account the big primary uptrend that goes right back to 2003. But we've seen a decent bounce off that, and whilst it's still too early to say that the China Hong Kong stock markets have completed an inflection, we can't say that technically at this stage. What is interesting is downward momentum has really dissipated, and we're seeing that primary downtrend retested again at present. So, the fundamental backdrop is improving. I think the economic data that's coming through is not as bad as everyone thought. The property market deleveraging, which has been going on for some time now, has been cushioned by the government. Would have been a lot worse if they hadn't stepped in. A little bit like what happened here in 2008 and in the US, when the government stepped in to shore up the banks and the property market. Over there, the Chinese government has been busy pulling a lot of levers, and they'll just continue to do that until those measures finally beginning to tally up and turn the economy around. So the stock market's a discounting machine. It looks 6 to 12 months ahead at least, and we can expect a dynamic upside breakout to happen well before the the full turnaround in China's economy to occur. So the stock market can be a leading indicator in that respect. So, I just continue to watch this chart. What I am finding, Pat, is I'm finding there's a lot of stocks listed in China with really compressed multiples. They sell for a fraction of the US counterparts. I'll use music streamer Spotify. It's got a much more expensive valuation than Tencent Music, yet Tencent Music, which is the Chinese music streaming leader with about 80% market share, is growing at a much faster gait. But one stock that I thought I'd showcase today, for the members, is the gaming companies. And what's been interesting is we've had this nice sort of breakout in Wynn Macau, which has coincided with a big recovery in gross gaming revenues and consumer spending. It's not quite back to where it was in 2019 at the peak before the pandemic, which coincided with Wynn Macau trading at $32, but it's not far off it, and it's heading in the right direction. And Chinese consumers, they're continuing to spend money on entertainment and gaming and frequenting Macau as a holiday destination. So I think that Wynn Macau's got upgrade potential that could happen post their quarterly results, which come out later this month. So that's one to watch. And I think it's quite significant technically that Macau's finally broken this sort of primary downtrend. So that says to me the path of least resistance is now on the top side. So that's one that we own in the Global Contrarian Fund and across our portfolios.
Okay, so that brings us to some of the questions. Angus, I'm getting a couple questions here on what are your favorite gold stocks, if you had one or two, or what do you think is the best way to play gold at the moment? Would you sit tight and just let it run, or are you still looking to accumulate anything?
Well, I think, just sort of emphasizing what we were sort of saying about those ETFs, GDX, GDXJ, which are the VanEck Gold Miners ETF and the VanEck Gold Miners Junior Gold Miners ETF. It's a great way to play and get equity leverage to the gold price if you don't want stock-specific risk. So I still think there's a place for those, because we all know mining is inherently tricky. It can start raining, it can start flooding, the mine gets knocked out of action for 4 weeks. There's a production downgrade. The stock's down 20% kind of thing the next day. There's volatility around it. So if you want to avoid all of that, the ETFs are a great way to play it. I like like in Australia, I like Evolution because 30% of their revenue stream is going to come from copper, and I think they'll be showing that. They'll show that acquisition was quite timely. I still think they screen cheap at sort of 384. We own quite a lot of them. We've got everything from sort of Red 5 to Gold Road is another one, Northern Star, St. Barbara Mines. That's a smaller one, but a lot of gold in the ground. It's probably not been recognised by the market. So I think there's a range of gold stocks out there in Australia. And if you the best thing is to diversify your exposure and have a basket of them.
Okay, a couple of questions. If we pivot back, interest rates. Do you see the Fed cutting? At what point in time you think they're gonna hold on, or do you think what are we going to see with the interest rates?
I think the consensus is looking for 3 cuts this year, commencing in June. I don't think that's going to happen. And the reason I say that is if you listen to the Fed is data dependent. We look at inflation; it's been coming down, but it's proving pretty sticky at 3%. And I just don't think the Fed needs to be in a hurry to cut rates. I think they will commence cutting an easing, but it may not be a mid-year story. It might be a September story.
And what do you think about here in Australia? You think we'll see anything in 2024?
I'm hoping that we get one before Christmas, Pat. But
Okay.
but we all got disappointed at Christmas time, not getting the toys we wanted. And I think there's risk in Australia. We've had a lot of have had falling inflation, but it's proving sticky. It's proving sticky, and the risk is that commodities start surging, we start paying more at the pump for petrol, food prices start going up, base metals start going up, cost of construction goes up. There's a raft of cost pressures that could sort of come through. So, whilst I'm sort of hoping the central banks are going to commence easing, this year, and the US, commences in June, I'm not putting my hat on that at all.
I think we paid a little bit more for our chocolate this Easter as well. And you touched on the cocoa prices earlier.
Yeah, I mean, chocolate's going to soar now that cocoa's through. I think it got to nearly 11,000 a ton. So it's big money. So yeah, I think there is risk that we get pushback on that mid-year rate cut narrative. And
Okay.
the other thing, the canary in the coal mine, is that US 10-year bond yield. We don't want to see that start running away to 5%. And I think that the stocks that are particularly exposed are those mega cap tech stocks, the AI stocks. Anything with a huge price earning multiple on it could well prove quite sensitive to that. So I sort of prefer the other end of the market. We've got a leaning into commodities at the moment. We've got a leaning into Japan. Japanese financials are going to benefit from rising interest rates. And I'm also leaning into China. I'd rather have exposure to a market with a PE of 8, where you can sort of pick the eyes out of stocks and companies that are growing their revenues at a good rate and are diverging in terms of their relative performances, than putting my head into the jaws of a lion's mouth, buying Nvidia at ginormous multiples.
And how about the banks in Australia? Are you still
I think they're due a pullback. They've had quite a good run, but I think with the banks, a lot of them have exited 10-year downtrends, so I think they're going to come back in quite a major way. It's good to see that the brokers are pretty cautious. So I'm just sort of waiting for timing, really, to increase our exposure there, and we'll be adding to our banking position, and potentially even going overweight, relative to the market, should we get that decent opportunity. I think that Australia, they've been running on expectations of rate cuts, and we talked about that. And in Australia, the banks actually need the rate cuts to make them work, make their margins work better. Rate cuts here will accelerate loan demand. It'll also reduce costs of interest paid on deposits. So it's a tailwind for the Aussie banks when the RBA does commence cutting. It also reduces the risk of Australia going into recession. But again, as we were saying before, I wouldn't be rushing out to buy them after they've had this big run to the top side. I'd be waiting and trying to get the timing right. More importantly, where the inflation numbers go, and what happens on the on the RBA easing side of things. I think it's going to be a very late in the year story.
okay? A couple questions on your view on the insurance sector here in Australia.
Yeah, I still like the insurance sector. I like Suncorp and QBE in Australia. I think premium margins holding up pretty well. It's pretty defensive. We haven't seen too much competition in that space to really impact those margins. And of course, they're now getting a lot more money and a lot better return on their float. And that is the premiums that come in. Insurance companies invest that in fixed income securities, and they're just making a lot more money now with interest rates higher. I don't think we're going to see interest rates go down to anywhere near where they were cut during the last cycle. In fact, I think bonds are actually in a secular bear market, and if anything, in the next phase of that cycle, we'll see the bond yields at the long end of the curve a lot higher into the short end. So I think these are all really good tailwinds for the Aussie insurers, of which like Suncorp and QBE. That's one of our other big positions, and I also like Dai-ichi Insurance in Japan. All those Japanese banks sell for price to book multiples of around 0.8, 0.9 times, which is compare that to Australian banks at 2.1. And if we look at the PE multiples, they're trading at 11 times in Japan versus 16 here. So yeah, I like the banks here, but I'm just not rushing out to buy them, and I'm staying overweight on our Japanese banks.
Okay, and any key economic data or anything that you're looking at over the next couple of weeks before we reconvene with the macro webinar with the members?
Big number coming tomorrow is the non-farm payrolls. So consensus economic forecast of 200,000 new jobs to be added. That's going to be an important number. If it comes in hot, and by that I mean it comes in at say 300 or high twos, I'd expect the bond market to react quite badly to that, because it just indicates that there's too much tightness in the labour market, which is exerting upward pressure on wage growth. So that's what we've got to look forward to tomorrow. If it comes in at sort of 200 or anything below that, the market, the bond market will like that, I imagine. Well, I'm not holding my breath on that front. The stock market will probably respond quite well to a 200 print or anything below.
Okay, I think that covers most of the stuff that we wanted to get through today and most of the questions we've gotten from the members. Angus, thanks again. Always good to catch up with you every couple of weeks, and we hope all the members got good value out of the presentation today, and we look forward to talking to you in a couple of weeks' time. Thank you and goodbye for now.
Thanks, Patrick.